Good morning, everyone. I'm so excited about this upcoming chat with Chris. I think we've been planning it for quite some time, and I know Chris for a while, and he's such an inspirational person, and what he built at What3 was, I think everyone should hear about that. But before we go into the conversation, I just wanted to establish what Media for Growth actually is as a financing option, and I think a lot of us here, a lot of startup founders, if you are in the market for fundraising, I think you should know of more diverse funding options such as Media for Growth.
You're an awesome person. Sorry.
So probably everyone knows of Zalando. It's one of the largest e-commerce fashion platforms, not only in the DACH region, but worldwide right now. I think timing is such an important and unfortunately less predictable factor when it comes to the success of a company. They started just 2 months before the financial crisis in 2008. And just 1 year later, they closed a deal with Seven Ventures, which is ProSiebenSat.1's Media for Growth arm. A couple of years later, they increased the sales revenue and they expanded from just a few countries in Germany when they had their first media campaign to all around the world. Pinterest. Probably some of you are using this social media platform to save recipes or maybe things that you want to buy, clothing. They chose the UK and Channel 4 for the first TV campaign a few years ago. And since then, they've done it again and again. I think the most recent one just aired a couple of months ago. Pinterest IPO'd in 2018 or 19 with almost $12 billion company valuation, and is probably the highest profile of a social media company on US stock exchange after Snapchat. And About You, very similar to Zalando, but equally successful. They were founded in 2014, and again, they partner with the likes of ProSiebens, and very, very quickly became Hamburg's first unicorn a few years later. What all these companies have in common, apart from a great product execution and just an amazing business model, is basically their approach, less conventional approach to advertising, and that is to partner with media broadcasters in a form of a Media for Growth partnership. That's what we call Media for Growth. Essentially, it's a financing option where companies can receive advertising and services such as TV, outdoor, print, radio, in exchange for equity or sometimes a revenue share. And many, many companies have raised Media for Growth funding over the past few years. Simply put, imagine ProSieben agreeing to do a $1 million TV campaign. They would provide that media to you, and then in exchange, they will receive the equity remuneration of that net media value. But this funding option is not very well known, at least not so much the moment you leave the UK or probably the DACH region. In Central Eastern Europe, there's been some attempts, but so far we don't have a success story as probably we have in the UK, and Chris will tell us about that in just a bit. So we basically started asking ourselves, how are these companies doing? Who actually raise Media for Growth? What are the most active players? And can we look at Media for Growth at a global level? What is the state of this industry right now? So I hope you can see from the chairs. I think it's actually quite important to probably look at some of the next slides. We put months of work in trying to research this space, which unfortunately is a bit scattered and the access to data is quite limited. So we've done our best. I'm sure we just scratched the surface this time. So Media for Growth, you see on the left side the growth in the number of funds. It actually emerged during the dot-com bubble, which I don't think it was just a coincidence. And we'll see in the next slide why it's so much impacted by the macroeconomic factors. But what's quite interesting is that aggregate media in Sweden, they are indeed the pioneers of this model. But they have a quite interesting and innovative approach. They aggregate media from different partners, and their model is very similar to a VC fund. The first publisher to do so and to actually start investing pretty much of the balance sheet and with their own media is Brain Capital International, which is a Times Group venture arm. And they did this in 2005, since then investing in over 900 companies, including What 3 Words. Another interesting factor to see here is how the progression of these funds and the raise of CVCs, the corporate venture funds, are actually proportionally the same in terms of growth. And one of the main reasons, I believe, is that you'll see a lot of the companies that raise media for growth funding, they co-invest, some of these funds, they co-invest alongside CVCs or venture funds. Just recently, one of the companies that we work with, Phil, they're based out of UK, they also raised from ITV Ad Ventures, and they just closed their Series A round where they have participation from many other investors. Media for growth deals, as I said earlier, they do fluctuate quite a lot when it comes to different macroeconomic times happening during those deals. And you will see that there is quite a steady increase over time. But then in 2020, right at the start of the pandemic, when the advertising spend decreased, we also knew that at the time there was less capital available in the market. The media for growth deals, basically, they've gone up. How do regions compare? I guess there's no surprise that we see most of these deals being concentrated in Europe. This is the birthplace of media for growth funding. But what's quite interesting, and what we're trying to show with this report, is that there are a lot of emerging regions that were lagging behind, and they're just coming up and doing more and more deals, such as Latin America, Televisa, who just completed the merger with Univision. They've invested in over 11 to 18 companies. Some of them are still in the pipeline, I guess. And then we have India, we already mentioned, and Southeast Asia, interestingly enough, with some independent funds such as Fay Media Global. Another interesting stat, again, not a surprise, most of these companies, the first time they raised media for growth funding, they were at an early stage, but not too early enough to disappoint the customers. So you have to have a proven business model. Most of them, they were at a seed or a Series A stage. They already raised an initial round of funding. And that's really important, because when you go forward and raise TV advertising, you have to be at a certain stage of maturity, and you have to be in some of the major cities not to disappoint your customers. There are some more interesting stats, such as the average raise, which is what we found. We looked at 87 of these companies that have been acquired. It's a very, very small sample size compared to what's happening right now, of course, in a global traditional venture landscape. But we also have to remind ourselves that this is a relatively early model. The 87 companies that we've seen in our analysis that have been acquired, they raised on average $87 million, and that's 3 times as much than a traditional startup out there. And then we'll see, when we hear from Chris as well, everyone probably thinks that this funding model would only work for me if I'm a consumer business. And in fact, of course, that's probably preferential. We have a lot more companies, including SaaS enterprise business solutions, that have raised such funding. And that's really comes down to what kind of media you have available and what your objectives are. The Times of Group India, for example, has over 700 million users. They can reach 700 million users daily. They can offer from print, TV, outdoor, and many other channels. So as long as you have the flexibility in choosing what works for your business, it is possible to raise, even if you're not a consumer-facing business. And Chris will also explain how they've done it at What 3 Words, which essentially it's a B2B2C company. Startups backed by both media and VC investors, according to our analysis, they reached the exit round via IPO much faster. If we actually think about it, a strong brand equity, we've seen it in other studies as well, they relate directly to the stock prices. And then lastly, some of the most popular industries where we've seen these deals being concentrated, it's e-commerce, digital health, fintech, food, and beverage. But we have a lot more industries emerging, such as gaming and edtech.